Hi friends, my name is Rohan Bharachandra. Today's video, stock prices, is it the right time to buy a measurement? Watch this video because it's very interesting, some technical information here. Another crash for global stock markets today. Nifty had fallen by more than 1.5% today but finally closed only 0.65% down. The more the markets are falling, the more attractive the stock market valuation is becoming. If we take into consideration 1 year forward PE ratio, which is a PE ratio assuming a percentage of growth in profits of a company, Nifty 50 index is trading at 17.35 times compared to the 10-year average of 17.57 times. The similar figures have been compiled for other global stock markets too. Nifty 50 1 year forward PE ratio 17.35, 10 years 17.57, 0.22% negative. That means the 1 year forward PE ratio is lesser than the average PE ratio of the last 10 years. S&P 500 17.34, 17.72, 0.38% negative. Nasdaq 24.6, 23.54, 0.82. So that means 1 year forward PE ratio is more than the average. Similarly, minus 3.24% for FTSE UK, CAC France 2.05% negative, DAX Germany 1.87% negative, and then Nikkei 2.39% negative, Hang Seng 1.78% negative, Shanghai 0.97 negative, and Kospi 1.59 positive. That means current valuation is slightly more than the 10-year average P ratio. Apart from this, there are two famous valuation indicators to know what level the markets are trading and whether it can be considered overvalued or undervalued. First indicator is called Bear indicator, which means bond equity earnings ratio. Bear indicator is a ratio used to evaluate the relationship between bond yields and earnings yield from stock markets. It gives an idea whether it is better for investor to invest in government bonds or stock markets. Government bonds give safe returns and the returns do not fluctuate too much compared to stock market returns. Currently, the yield from government 10-year bonds is 7.33% per annum. So the bond yield is 7.33%. Equity earnings yield is the inverse of P ratio. You would know the P ratio is price of a stock divided by earnings per share, or the price of index divided by the earnings for the index. Equity earnings yield is the ulta or the inverse, earnings per share into 100 divided by price of a stock or index. So if we put it for Nifty, the Nifty earnings per share, if you look at the internet, it is 840, and then into 100 divided by average 16,950 is the Nifty index level currently. So 4.96% is the equity earnings yield. So the Bear ratio is calculated as bond yield divided by equity earnings yield, that is 7.33 divided by 4.96, 1.48. This may be slightly technical, but you need to understand the broad meaning of this. Below 1, if the Bear ratio is there, then stock market is undervalued. If it is 1, then stock market is fairly valued. If the Bear ratio is above 1, then the stock market is overvalued. So as per the figure right now, stock market is overvalued as per Bear ratio. Indicator number 2 is called Buffett indicator or market cap to GDP indicator. Warren Buffett, one of the richest men in the world and one of the most successful investors, had created an indicator many years back called the Buffett indicator. This indicator gives an idea whether stock markets are overvalued or undervalued. Buffett indicator formula: market capitalization of listed stocks into 100 divided by GDP of the country. If the indicator is below 100%, then it is undervalued, above 100%, it is overvalued, and if it's exactly around 100%, then fairly valued. Currently, market cap of all Indian stocks is 246 lakh crores. India's GDP 273 lakh crores. So Buffett indicator is 246 into 100 divided by 273, approximately 90.1%. As per the Buffett indicator, Indian markets are looking undervalued as of now. In the peak of January 2008, the Buffett indicator for Indian stock markets was 160%. But the long-term average, that is 10 years of Buffett indicator for Indian markets, is 80% only. The current figure is coming close to the long-term average because it is right now around 90%. So as per Bear indicator, Indian markets are still overvalued. However, as per Buffett indicator, Indian markets are undervalued. So little mixed signals are coming from these valuation indicators. Due to the recent fall in stock markets, Indian markets have become more attractively valued compared to historical average. However, comparatively, other global markets are further attractive, especially for FIIs. Hence, continuous selling has been done by FIIs in Indian markets for the last few months, and most of the money has been going to other markets, including Chinese markets. If you like this video, please click the like button, and many people are hoping and expecting Nifty to fall to 15,000 level. Do you think it will happen in 2023? If yes, type yes in the comment section. Otherwise, type no in the comment section. Thank you for watching this video. Bye bye and all the best.